Hello, my name is Joe Hoyle, speaking to you today from the University of Richmond. We're going to look now at Chapter 9. And Chapter 9 is really a continuation of our coverage of inventory that we began in Chapter 8. A good portion of Chapter 9 is about cost flow assumptions. So the first thing that I want to make sure of is that you understand why we even need a cost flow assumption. When we cover this in my class here at the university, I will often assume that the students are running grocery stores and that they buy a can of tuna fish for $1 and then they buy a second can of tuna fish for $2. Apparently there was a lot of inflation. They then sell a can of that tuna fish. Which cost do you move from inventory to cost of goods sold? Do you move the first cost, the $1, or do you remove the second cost, the more recent cost, the $2? It will make a tremendously big difference in the way that you report your information based upon whether you move the first cost or the last cost or some other cost. That is the problem that the accountant faces whenever inventory has more than one cost. And obviously, as you buy goods, it will frequently have more than one cost. You'll buy a case of something for $10 and the next one will be $11. When you sell that inventory, which cost do you move from inventory into cost of goods sold? Now there is one possibility that's called specific identification. In some situations you will actually know the inventory that is sold. For example, a car dealer will know exactly which car was sold and can move that precise cost from inventory to cost of goods sold. However, in most situations, knowing the exact inventory that you sold is clearly not possible. Most companies don't keep up with it and don't know what it is. Therefore, you have to make an assumption. It is the problem that you don't know which inventory was sold that leads to a cost flow assumption. There are three major cost flow assumptions: first in, first out, last in, first out, and averaging. First in, first out is known as FIFO. It makes the assumption that the first cost is the one that you move into cost of goods sold. Now keep in mind, and this is very important to avoid confusion, you don't know which inventory you actually sold. That's not the point. Since you don't know, you have to make an assumption. And the assumption that you make under FIFO is that it was the first that you bought is the first that you transfer to cost of goods sold. If you buy 2 cans of tuna fish, the first for $1 and the second for $2, and you sell 1 can of tuna fish, then you transfer the first cost, the $1, from inventory to cost of goods sold. And therefore, the last cost remains an ending inventory. LIFO takes the opposite approach. Last in, first out is known as LIFO. It assumes that the most recent, the last cost, goes from inventory to cost of goods sold, and therefore the first cost remains in ending inventory. It's an assumption. It makes the company able to come up with reported net income. If you're applying LIFO and you buy a can of tuna fish for $1 and then later buy another can for $2 and you sell 1 can, then you transfer the $2, the last cost, from inventory to cost of goods sold, which means that the first can, the $1 can, stays in the inventory. Do you know which inventory you sold? No. That's not the point. You're making an assumption. As the name averaging implies, averaging assumes that the average cost is transferred from inventory to cost of goods sold and that the average cost remains in ending inventory. If you buy 1 can for $1 and a second can for $2, the average cost is $1.50. So if you sell a can, then you transfer $1.50 from inventory to cost of goods sold, and $1.50 remains in ending inventory, the average cost. You have to make a cost flow assumption unless you know the specific identification of the items you sell. As you might imagine, each of these cost flow assumptions shows certain characteristics. Now, I'm going to assume here that we have inflation, that prices rise. The characteristics tend to reverse if you have deflation. But in most industries, you rarely have deflation. We usually think about inflation. We usually think about prices going up. For FIFO, if there's inflation, you will have a higher net income reported, and you'll have a higher ending inventory. And the reason is that the first cost, the cheaper cost, go to cost of goods sold, while the later cost, the more expensive ones, stay in ending inventory. For LIFO, you have the reverse effect. LIFO tends to report, especially in inflation, a low net income and a low ending inventory. And in fact, over a long enough period of time, the LIFO ending inventory will become extremely low. For averaging, you have an impact that's in between. The net income is not quite as high as FIFO, but usually is higher than LIFO. And the ending inventory is not quite as high as FIFO, but it's usually higher than LIFO. Now immediately, one of the questions that you should ask is, why does anyone use LIFO in inflation? If it deflates the income, if it makes the income look lower, wouldn't companies be hesitant to ever use LIFO because it will make them look worse? Well, the answer is obviously yes. But there's an interesting characteristic in the United States tax rules. Remember, there are two sets of rules about accounting. FASB produces U.S. GAAP for financial reporting. Congress and the Internal Revenue Service produce rules for tax accounting. So the way that you report for income taxes is most often different from what you report for financial reporting purposes. However, there's one major place where the two overlap. About 70 years ago, Congress passed a rule saying that you had to have LIFO conformity. What that actually means is that if you choose to use LIFO for your tax return in order to show a lower net income and thus pay a lower amount of income taxes, then you must use LIFO for financial reporting. As far as I know, there's nothing else like this in the Internal Revenue Code, that you have to use something in both the books and for tax purposes. But for LIFO, you do. If you choose to use it for tax purposes, LIFO must also be used for financial reporting. Without LIFO conformity, you would probably not see LIFO used very often at all. Now, why is LIFO criticized so much, other than the fact it reports low net income? There are several problems that we associate with LIFO. The first is, as we've already mentioned, that over a long enough period of time, your inventory on the balance sheet will be well outdated. If you buy a can of tuna fish for $1 and you buy and sell for years and years and years, and tuna fish becomes very valuable, on your balance sheet you may still be showing one can at $1, even though tuna fish hasn't cost that much in decades. LIFO will have a number for ending inventory that's virtually unusable. Not surprisingly then, companies that use LIFO will often include footnotes to help the decision maker understand what those numbers would be if FIFO had been applied. In addition, you can have what's called a LIFO liquidation. If you reduce the quantity of inventory, some of those earlier costs will be moved into the current period. For example, if you buy a can of tuna fish 20 years ago and you finally sell your last can, then that earliest cost, 20 years ago, is moved from inventory to cost of goods sold. That's a mismatched revenue cost of goods sold figure. For those two reasons, LIFO is often criticized from a theoretical perspective. And in fact, for international financial reporting standards, LIFO is not allowed. And again, it would probably not be used in the United States except for the LIFO conformity rule. Now at some point we have to go back and bring back in periodic and perpetual inventory systems. Remember from the previous chapter that they were used to keep up with the quantity and the cost of inventory. So what a company really has to do is to merge periodic or perpetual with their cost flow assumptions. So you might have a periodic FIFO system or a periodic LIFO system or a perpetual FIFO or a perpetual LIFO. Averaging, if it's periodic, is called weighted average. Averaging, if it's a perpetual system, is called moving average. So you have to combine the two. The question I want you to think about is, in a periodic system, when do you apply the cost flow assumption? In a periodic system, the cost flow assumption does not become important until the end of the period when you're computing the ending inventory and cost of goods sold. Remember from the previous chapter we said that you count the ending inventory and then you use a formula, beginning inventory plus purchases minus ending inventory, to get cost of goods sold. The cost flow assumption comes in when you count the ending inventory and you determine what those units cost. Otherwise, the cost flow assumption is not used. But when you count ending inventory and you know the number of units and you're determining what they cost, then you have to apply the cost flow assumption. In a perpetual system, you always move inventory to cost of goods sold as soon as the sale is made. Therefore, the cost flow assumption comes into play every single time you make a sale, because it's at that point that you're transferring inventory cost to cost of goods sold. One last point to make. We end this chapter talking about several vital signs that decision makers like to use to help them observe the financial health and future prospects of a company. Be sure to note these because these allow you to make better use of accounting information. Two in particular I want to mention here. The gross profit percentage. Gross profit is the sales minus cost of goods sold. So therefore, the gross profit percentage is that gross profit figure divided by the sales figure. It helps you to determine how much a company is able to mark up its inventory before it sells it. This is a number that most decision makers look at very carefully. Another vital sign that you should be aware of is inventory turnover. Cost of goods sold divided by the average amount of inventory for the period. This helps you know how long it takes a company to sell its inventory. Clearly, companies are better off if they can sell their inventory fast so that they get their money and that the inventory doesn't have the chance to get old. This is great coverage of Chapter 9. You need to go read this now. Look at cost flow assumptions. Look at vital signs. Let's add to your knowledge of inventory. Have a great day. Study hard.